Right. So I welcome everyone. And in this session of this very course, we are going to be taking a look at transitioning from basic to advanced resistance and support zone. Right. So that is a topic, our topic of discussion right in this video. So we are going to take a look at basically how you can transit or transitioning from the basic to advanced resistance and support. If you can recall the title of this course, I made use of advanced forex trading, right? So some of the things that we're taking a look at, we're taking a look at how we can change our mindset or position our mindset from just being a retail trader to institution to see how institution control the market so that we can align our trade with them to move the market. Introduce support and resistance form the foundation of every price action trading. However, most traders only understand them at the basic level, right? So seeing them as simple horizontal lines where price bounces in advanced trading, support and resistance zone represent deeper market psychology. So we have to know that this zone is not just an ordinary level that the price just tests and return. There are very deep meaning to it if you go deep to understand how institutional players exploit all these points that we take lightly. Areas where institutional orders, liquidity hunts, and trend shift occur. Basically, support and resistance is a level where institutional collect orders, right? When I mean institutional collect orders, institution can collect orders and you see a situation like consolidation, price moving sideways. That is order, collection, waiting the right time to strike. Meanwhile, we retail traders doesn't see those zone in that way. We just take it lightly as a common zone which the price takes and bounce back. So these points are very important. You need to understand because a lot of things happen when the price is rotating in a key zone or a key level, right? Ranging from liquidity horns, right? So institutions manipulate market around this region and kill retail traders a lot. That's why most of whenever I see a price going sideways, I give it a name, right? I give it a name. Once the price goes sideways, I personally call it kill zone. That is the name I give to it. I don't know if that is how other traders call it, but I decided to call it kill zone because once you see this movement, you have to be careful because a lot of retail traders are going to be, taken down or taken out of, the market. So mastering the advanced concept means reading how and why price react around these levels rather than a main way that you feel the price there. So basic and advanced understanding. Most retail traders mark a line where price has bounced before and expect another bounce in the future. This method works occasionally but lack context. That is why I do say if you have the deep understanding, you know that for price to test this zone repeatedly doesn't mean it cannot be break, right? You're just waiting for the right time. Anytime institution decide to break this level, they are going to break. This is liquidity hunt at this point, right? I think I've explained all this liquidity or stop loss hunt either in this course or even in my previous courses in my catalog. I've talked a lot about the stop loss hunting or liquidity graph. But we're going to still deal with it in this course. Let's move first. So this method works. Done with that. It ignores whether institutions are accumulating or distributing orders around those levels. Advanced traders see support and resistance as zone rather than a line, right? This zone show areas of interest where order flow has built up. They also combine support and resistance with price structure, candle behavior, liquidity awareness to judge whether a level will hold or break. So this is how institutions view this zone or advanced traders. And I'm sure this course is going to really expose our mind and make us take this level serious henceforth to see that there is more to it than this is how most retail traders acknowledge this zone just with a single line. Maybe they can sometimes make it tick a bit. That is a zone. But this is a very bad or dangerous play as long as market is concerned. An experienced trader cannot use this, right, to identify a zone. I'm going to talk a bit on it. That is the essence that you purchase this course to get the clear understanding. I don't just point the lapses between retail and institutional trader or advanced trader. I also give the solution as well, what I've experienced or have practiced over these years. Advanced understanding identify, okay, the key difference between basic understanding. Retail traders basically draw flat lines, focus only on a fast bounce, react to the market, ignore wicks and imbalance. Advanced understanding identify dynamic zone, evaluate liquidity, order build-up, and suspend reaction before they fall. Use candle wicks to gauge liquidity sweep, right? How advanced traders use support and resistance. Basically, contextual mapping. Advanced traders analyze where the support or resistance level forms in the trend. The support in the downtrend may not hold because institution could be using it to trap before pushing lower, right? See this case. Okay, let me finish. I will explain. Then another uh, another point, zone creation. Instead of single line, traders mark a regular zone that capture the range of price reaction from wick to body, where buyers or sellers step in. This is how advanced traders approach multiple time frame alignment. A resistance visible on the 1 hour chart may be part of large weekly structure. Advanced traders align multiple time frames to find high probability confluence zone. Reaction confirmation, candlestick pattern like engulfing pattern or rejection will reveal whether the level is valid or being manipulated by liquidity graphs, right? So basically, I want to show you guys why it is not the best to use a single line to identify a zone, support and resistance zone. It doesn't make any sense. If you have experience in the market, you agree with me that this is a very risky play in that if you are using a single line to identify a zone in the case of this resistance zone, you may easily get tricks by institutional trap, right? Because any small candle move can easily break this single line and it will trap you because you may assume that it is a breakout just in this case, right? Any small move can easily break this line. But in a situation you are using a zone in this one, you know that before the price breakout of this zone, then the candle close above, then it is likely a valid breakout, right? Because you have given enough allowance to contain institutional traps and then liquidity hunt. Do you see what is happening here? This liquidity hunt, or you can call it stop loss hunting, liquidity hunts, or stop loss hunts, or liquidity traps. You can call it either of the name. What does this mean? Institution trick retail traders after order accumulation, and you can see price has tested this level several times, which shows that this is a strong resistance zone. So then at some point, institution trick retail traders as if this is a breakout, but price still return back and continue below this resistance zone. What does this mean? This stands for two things. They have cleared a lot of stop loss at this point. Stop loss cleared. At the same time, it is also a trick. It is also a trick to take another stop loss on this other side because impatient and inexperienced trader haven't seen this or haven't seen two-way scenario. Price has tested this over time, right? For this region and this. So some retail traders already assume that price is going to bounce at the zone, this resistance zone, using basic principles of assumption. Inexperienced traders, assumption, they use assumption because the price has tested this so many times could not break. So they now assume that this level is a strong level, hence price is going to react and return back at this point. So they took trade, maybe set that stop loss anywhere a little bit buffer dips above the resistance zone. So this haven't been done. They have sold the trade. Fine. People that took entry at this point might have certainly secured some tips. But the central idea is that this was actually a wrong move. You can't use assumption. So in this case, they have entered a sell trade. You can agree with me that this movement already cleared all the stop loss that was set above this region up to the level that this liquidity hunt stop. At the same time, This movement also trigged another set of retail traders that this is a breakout. So they will take a buy trade, set that stop loss below this zone again. All of a sudden, you see the price return and continue downward. So they have secured a lot of liquidity. They have cleared a lot of stop loss in these two scenarios, which I just described. So what should you do to avoid a scenario like this? Short time frame traders might have traded all this when having seen a sell confirmation because price tested this region several times. Good. But the best thing to do is that whenever you see price ranging in this way at a resistance, let's say this is our resistance zone, this is our support resistance, and then support level support. Whenever you see price ranging inside this zone, what you should do as an experienced trader, you have to wait for liquidity grabs to happen, right? If this is a price movement and all of a sudden, as the price was going, you see the liquidity grabs downward, they break out at this point, then that means the sell candle, they break out on the sell direction, and this form a candle outside the region. And retail traders likely feel this is a breakout, but all of a sudden you see the candle pull back and still close within this range, leaving all this as a weak. Then the psychology behind this is that there is likely 80% chance that the real breakout is going to happen on the upside. If this was an inverse situation, price return, all of a sudden price was going green, which is a buy candle. Please take note because this doesn't have much to do with analysis. It's just a market psychology which you need to take note, then try to spot it and also observation on your own. So this turn to green candle automatic buy. Then before the candle close, depending on the interval or the time frame, you see the candle return and turn red, bearish, leaving a rejection. Know that this is a very strong zone and there is likely a chance that the real breaker is going to be on the downside. So that's the two-way scenario to mark out your zone. And the advantage of using this zone is you are very sure within the range of this zone that this is a resistance or a support as the case may be or as the direction may be. But if you're using a single line to identify this level, you see that unnecessary breakout, unnecessary wick is going to point out just in this case. You can see. In short, I'm even trying to set this because it's a past market event. In a real time scenario, you see that many candles might have, okay, let me off this wick, right? You might have noticed that if it is a real-time scenario or something that we're expecting to happen in the future, you notice that a lot of candle might have break out of this line, and that will likely throw inexperienced trader into a confusion that this is a breakout. Meanwhile, it is not a breakout, rather institutional trick. So whenever I see this thing happen, then the price return, then you have to carefully wait for a confirmation candle once the price fell back to the zone. Confirmation candle is going to give you the go ahead to take your entry, knowing that this is a serious zone. This is price rejection over time in this zone. You can see price respected the zone multiple times and could not break before this liquidity grab took place. Then look at the sell that took place. Obviously, after this liquidity grab, this is a confirmation candle that shows a selling pressure. So this is the right time for you to enter the trade. Entering here is confusion because you can't even tell if this is a real breakout as at when this incident took place. The only thing that will help you is market psychology, knowing fully well that liquidity has happened on the up, then likelihood that the real breakout is going to happen on the downside. So after the price broke out, return, what you should do is to wait for a confirmation at this point to note if that breakout was real or fake. And the type of candle to look at. The candles, all these candlestick formation have a name and what they stand for. I took time to illustrate them in one of my courses as well. So these candles have a names and what they represent, meaning whenever you see a candle form in the market, there is expectation that should follow it next, right? you should know what is going to happen in the market next whenever you see such candle. In this case, this is a bearish engulfing pattern. The sell candle completely engulfed the buy candle, meaning sellers are actively in charge of the market and they have strong momentum that are going to push the price downward. Look at what's happened next. Serious sell movement. So it's just like a parallel red candle all through, right? So that is it. If you don't know it, you have to go and research on those types of candle and what they basically stand for. So that's basically how experienced traders identify a zone rather than using a keyword. Sometimes institution can trick us as well. You cannot call a zone a resistance or support zone if the price hasn't tested the zone and retest many times, right? In a situation, you just see a simple zone or a point where the market has react only a few times on a weak time frame. That's key point. You can see this time frame is 4 hours. If you're using a small time frame, you have to be very careful because this zone is more dangerous on a small time frame than this 4 hour. 4 hour is a nice. If you identify a zone with 4 hour time frame, then that zone is likely valid. I also talk about using multiple time frame to confirm a zone. Now we have moved from 4 hour to 1 hour, and this zone is still very active even with the 1 hour. That's how to identify a key level or a key support and resistance using multiple time frame. Because it's the time frame that you're going to look at this and you look at the chart, the price hasn't reacted to it many times. This very one is still valid even with 15 minutes time frame, right? But on the 15 minutes time frame, this breakout might look like a real breakout. Meanwhile, it forms a pattern. I don't know how many people can see that with me, that the price actually formed a kind of head and shoulder pattern before. And head and shoulder pattern is a bearish pattern. Can you see that? So 15 minutes breaking out from this pattern, it also gives you a sign that it is a sell. That means this breakout is wrong. So you need to put all these things into place, right? Let me change the background color so we can see the pattern, how it looks like. Right, that is it. So this 15 minutes, it still shows you that this breakout was fake, right? It was a fake breakout, institutional trap. So you can use different strategy, different technical levels, different pattern to detect some of this movement in the market. Because when we are on a 4 hour and 1 hour, you could not spot this. And on the 4 hour, this breakout look fake because taking liquidity never take place on the downside. We are waiting to see it on the upper side and it did happen. Then moving to 15 minutes time frame, I used something else entirely to also confirm that this level was not real. Because after the level matter form, created the first left shoulder, price move from the head, return back. As soon as you see the right shoulder, you should know that there is high possibility that the price is going to still continue on a down trade. So what you have to do in this case, where should you trade? You should trade this on a neckline breakout and retest, and this is it. I'm taking this zone off, sorry. So I can show you guys when to enter the trade at this point. So if this is the signal or confirmation that you have, you might have waited, this has played out, this played out, this played out, then this also the right shoulder played out and break this neckline. At the breaking and retest is where you're going to take your entry, which is this level. This level, this is our sell entry to go short after a confirmation still. Neckline broken retest, and this is a sell confirmation here. And after that, you can see the bearish movement that took place in the market basically. So that is how to identify key zone. Then in summary, transitioning from basic to advanced support and resistance means shifting from reactive to anticipatory analysis, right? What do I mean by reactive in that scenario? You don't operate, when you understand how these things work, you don't operate on the principles of assumption, right? Assumption in the case that you know this is was a resistance zone. So you just assume, having seen price tested it maybe 2 or twice, 3 times, you not assume that every price that come here is going to bounce. It is not so. The level will always break, it's just a matter of when. So knowing that is going to make you, instead of reacting on assumption. You rather wait for those market scenario, right? Like the stop loss hunting, liquidity hunt to take place before you can now take their entry. There's no way, I don't think there's a way price is going to, on most cases, once you see price range moving sideways, expect a liquidity hunt before you take your entry, or else you're going to get caught by institutional traps. So instead of blindly trusting horizontal lines, focus on understanding the intent behind market move, observe how price behave around this zone, and combine structure, candle pattern, and liquidity for price decision making. Like I just illustrated with 15 minutes time frame. So I use market structure, candle pattern in that case to demonstrate that there was a head and shoulder pattern forming right there. And we all know head and shoulder pattern is a selling signal. So having seen that, I waited, price broke the neckline, then sell confirmation. Sell confirmation is simply those candle pattern that when you see, you should know that selling pressure is building in the market. So that is how to transit from basic to advanced support and resistance, right? So see you guys in the next topic. Thank you.